And the topic of my flash talk this morning will be hedge funds and whether they still make sense in client portfolios. Now, when we talk about asset classes with clients, hedge funds probably generate more questions, cause more concerns, and sometimes even cause more anger than anything else that we recommend. So with that, what we're going to do this morning is take an unbiased look at the numbers, talk a little bit about where we think that the industry is going, and then we're going to try and answer the question that we've posed with this flash talk here: do they still make sense in client portfolios? So first off, hedge funds are one of the fastest growing segments of the asset management industry. Industry assets today stand at almost $2.7 trillion. And interestingly, we've seen a lot of this growth in investment, especially since the credit crisis, driven by institutional investors like yourselves. So this data we're showing you here is from the client reporting software that we use called InvestorForce. And this represents more than 30 different consulting firms and over $4 trillion worth of client assets. So what we were showing you here is not just Marquette clients, but the broader institutional landscape. And as you can see, hedge funds are now a meaningful allocation for most clients, with about a 10% allocation for the median plan. So with this growth and institutionalization of the asset class, we've seen an increased amount of press coverage. And most of this press coverage has not exactly been flattering. And this has caused some investors to begin to question and even exit the asset class. And this has been most notably with CalPER's very high-profile exit from hedge funds. So what exactly is causing this rethink? Well, first and foremost, high fees. It can understandably be very difficult for fiduciaries to agree to pay 2 and 20, i.e. a 2% management fee and a 20% performance fee when you can invest in index funds for just 5 basis points. Additionally, these very high fees have contributed to the feeling that many hedge fund managers are grossly overpaid. And despite, or possibly because of these high fees, hedge funds have materially underperformed the U.S. equity market since the end of 2008. At the peak, the U.S. equity market outperformed hedge funds by almost 100%. Now, while we're at it, investors have also expressed concerns around leverage, complexity, and illiquidity. So the question is this frustration justified? So let's start with performance. It's important to remember that hedge funds are not simply long the market, they are hedged. As a result, they tend to do better relative to the S&P when markets are down and worse relative to the S&P when markets are up. But the beta exposure is not while they're in your portfolio. The primary reason is alpha. And our job at Marquette is disentangle how much of hedge funds' returns are simply due to being long risky assets, i.e. beta, and how much is from skill, i.e. alpha. So how exactly do we do that? Well, we use some fairly simple math that we all learned back in middle school algebra. I realize that seeing this formula may cause some of sweaty palms and bring back some bad memories somewhere in the audience, but I can promise you we will not have a test. Now, as a reminder, this is just a basic line function, but we can use this to regress managers' returns against a benchmark like the S&P 500 and use this formula to determine how much of the return is coming from market performance and how much is actually coming from manager skill. So in this simplistic example, if a manager has a beta of 1.0 and generates a 3% return when the index is only up 2%, we'd say that their alpha was 1%. But of course, this is a little more complicated for hedge funds because they have much less exposure than 1.0 to the market. In fact, their typical beta is about 0.3. So to make this analysis a little bit easier, we've separated alpha from beta. And what we're showing you here is just the cumulative return from alpha net of all fees. And when this line is upward sloping, alpha is positive. When it's downward sloping, alpha is negative. And you can see that alpha peaked in 2011. It's been downward sloping somewhat since then and then flat. This is obviously not good. This is not what we're looking for. But actually, this is a little bit unfair. Most hedge funds have global portfolios these days, and it turns out that the MSCI ACWI, a global equity benchmark, is actually a much better guide to whether hedge funds are actually generating alpha. And you'll notice that the red line, particularly recently, is still sloping upwards and to the right, i.e. alpha is still positive for the industry overall. Now, using that same analysis, we can show you both the return from beta, which we show you here in red, and the return from alpha, which we show you here in blue. And now you'll notice that the return from beta swings sometimes good, sometimes bad, obviously swinging around with the market. But the return from alpha in blue is much more consistently positive. And this is one of the benefits of having a hedge fund in a portfolio. Now, while we have seen positive alpha consistently over time, one thing that is pretty clear is that alpha has been noticeably lower since the credit crisis. So what exactly has happened? One big thing, and actually this affects all active managers, not just hedge funds, is that the playing field today is far more level. So beginning in 2000, the SEC implemented Regulation Fair Disclosure, aka Reg FD. And this prohibits company management from selectively disclosing material non-public information. Now this may sound obvious, like this of course, but actually in the heydays of the tech bubble, an investment manager could pick up the phone, call a company's CEO, CFO, ask them how the quarter was going, ask them about a rumored transaction. The CEO or the CFO could actually answer that question. Okay, today that is no longer the case. Both the asset management industry as well as company management take this regulation very seriously. And this is one competitive advantage that both hedge funds and active managers we don't expect to return anytime soon. This is a definite change within the industry. Now, another reason for lower alpha is shorts and hedges have clearly become harder to execute and less profitable since 2008 for two main reasons. One is that institutional investors have curbed their securities lending programs, and this leads to higher borrowing costs, making it more expensive to short securities. Now, the second reason is that the lower, i.e. zero, risk-free rate, which we show you here in blue, means that the short interest rebate is largely gone. And this has clearly had some effect on alpha, which we show you here in red. It is undoubtedly not perfect, but you can definitely see a trend here. Now, this is likely to change at some point. We don't know when, but the Fed eventually will raise rates, and when they do, the short interest rebate will return. Higher rates are also likely to make securities lending programs look more attractive and may bring additional institutional investors back into the lending pool. Lastly, keeping up with the US equity markets has been tough. This is particularly true for hedge strategies. Now in the blue, what we show you is the Fed balance sheet, and in red, we show you the S&P 500. And we highlight the periods when the Fed was expanding their balance sheet, i.e. engaging in quantitative easing. You can see that almost all of the cumulative equity market gains since 2008 have occurred during periods of QE. QE has clearly had a meaningful effect on equity prices. Now this actually has already changed. The Fed ended their last round of quantitative easing late last fall, and we think it's no coincidence that the relative performance of hedge funds has improved dramatically over the last 9 to 12 months. Okay, so maybe performance isn't quite as bad as we thought, but still, why bother? First, hedge funds help cut off the tails. So this is a histogram of monthly returns since 1990 for the S&P, which we show you here in black, and hedge funds, which we show you here in red. And you see much less dispersion in hedge fund returns. There are no left tail events. And this protection has actually been there when you've needed it absolutely the most. So in each of the last major equity drawdowns, which we show you here, hedge funds have materially outperformed other risky assets. In addition, hedge funds have offered important diversification. So as you can see on the far left column, hedge funds have had a 0.6 or less correlation to all traditional asset classes, providing important portfolio benefits. So when you put it all together, hedge funds offer an important benefit to your portfolio, which is what gets Greg Leonberger, our Director of Research and resident math geek, all excited. This is data from our asset allocation software, and as an example, what we're showing you here is if we add a 15% allocation to hedge funds to a sample portfolio, you can see that we actually don't do very much to the return of the portfolio. But you can see that there's a material reduction in risk. And this is what we're going for when we build client portfolios and have diversification across asset classes, generating attractive rates of return and doing so with the least risk possible. So where do we go from here? Greg already hit you with the slide a little bit earlier, but as he mentioned, these are our projected asset class returns from our asset allocation software. And you can see here that we expect that nominal returns on traditional asset classes are likely to be lower going forward in the future. And this is an environment where we think additional diversification will be that much more important. We've also seen that with the increased institutionalization of hedge funds has come increased regulatory oversight. Now the EU actually led the way here with AIFMD, and this alphabet soup stands for Alternative Investment Fund Managers Directive. This was launched back in 2011, and this was essentially hedge fund registration in Europe. Now, the SEC followed suit not too long afterwards, back in 2012, and they now require that all hedge funds managing more than $100 billion in third-party assets register with the SEC. So the upshot of this has been that along with higher quality service providers and better due diligence by investors broadly, we've seen a significant reduction in hedge fund blowups. Now, how about performance? With the Fed expected to raise rates later this year, or sometime in 2016, investors may want to consider how their portfolios are likely to perform during the next rate hike. What we show you here is asset class performance during the entirety of each of the last 3 Fed tightening cycles. Fixed income here is in gray. We show you equities, US equities in red, and then the broad hedge fund benchmark all the way on the right side in black. And what you'll notice is that hedge funds have generated positive returns in each of the last 3 Fed tightening cycles, and they've also outperformed traditional asset classes, i.e. stocks and bonds. So while there's certainly no guarantee that history will repeat itself, we think that having hedge funds in a portfolio can be helpful in the next tightening cycle. And lastly, some good news on fees. While hedge funds remain a very high fee asset class, we have seen a trend towards lower fees over time. As institutional investors have allocated more to the asset class, we've seen increased pressure on both management fees as well as performance fees, and we expect this to continue going forward. So where do we fall out? We still think hedge funds have a place in many client portfolios. Manager selection undoubtedly matters. This is a very high fee asset class, and not all funds are worth the fees that they charge. We spend a lot of time at Marquette trying to find those managers that generate attractive risk-adjusted returns that are commensurate with the fees that they charge clients. And we also do think that the future is likely to be a little bit brighter going forward for hedge funds. The end of QE and higher short-term interest rates should help hedge strategies generally, and we expect that lower returns from traditional asset classes highlight the importance of diversification. And lastly, we continue to expect fees will come down, and we continue to spend time finding managers who will generate attractive risk-adjusted returns that match the fees they charge our clients.